Subadra, I wonder, we talked just briefly with Steve about the expectations here. There is at least some sign that the economy may not be all as rosy as we think it is, and banks may be prepping for a little bit more of a headwind ahead. Does that change the outlook for the Fed at all?
Yeah.
Well, I think today's data definitely caught the market by surprise. As just before the news broke out on the regional bank, what we saw was actually the market wasn't fully pricing in a March rate cut. Now, the odds of a March rate cut have definitely increased after today's news. Broadly speaking, the economy has been relatively strong. You're looking at a very strong third and fourth quarter of last year. The momentum seems to be working its way into the first quarter, I should say the first month of the year. So we think it's probably a little bit premature for the Fed to cut rates at the March meeting. Perhaps a May or June start for rate cuts makes the most sense, given how strong the data has been and how, we're going to get an employment figure on Friday. I think you're going to get a relatively strong print. Inflation's been trending lower. So I think that the Fed has the luxury to wait before they cut rates.
All right, a weaker than expected private payrolls number, inflation perhaps softening. Paul, Christopher, let me head over your way as well. The economic picture broadly, I mean, not very many people can dispute that some of the general headline numbers have been solid. Does the Fed have cover to be able to wait this out a little bit more, or are we keying more on things like the private payrolls report this morning and the problems that we're seeing at New York Community Bank?
The Fed does have cover to wait a little bit longer and to be a little bit more patient. That's been their game plan for the last several months. We think they'll continue that. Look, if the economy is going to grow strongly, then earnings will be better than expected, but inflation will take longer to get down to 2%. If the economy is going to all of a sudden fall off a cliff, and maybe we have banks leading the way, then you don't have a real good earnings picture, but you might get the Fed to cut rates. We don't really see how you get this Goldilocks scenario of the economy's still strong, but the Fed cuts rates and inflation falls.
That's a good point. And Joe, with that in mind, what would then be the strategy, and what are you seeing through your models? Is the U.S. economy in as good a shape as the headline hard figures would dictate?
I don't believe so, Dom, because the income side of the economy shows a much weaker profile on growth than GDP does. We don't have the fourth quarter numbers yet, but we have seen last year, for example, employment being revised down in 10 of the last 11 months. So the income side of the economy shows a much different profile than the GDP data. And my guess is when we get the fourth quarter income numbers at the end of March, it will continue to show weaker growth. What I think matters in the short run is the fact that inflation is at the Fed's target, actually a shade below. If you look at the 6-month rates of annualized change in the core PC deflator, which is the Fed's preferred metric, we're actually under 2% in the last 2 months. The reason why I believe the Fed should cut, and the Fed should cut as soon as March, is because monetary policy has to anticipate where the economy is likely to go. And with where real rates are, if just the inflation numbers themselves continue to trend downward, as I believe the momentum shows, the Fed will want to offset that, lower those real rates, and begin that process sooner rather than later.